Hello everyone. Today I'm going to talk about the recapture of prior year um, ordinary loss. So before a company can treat its Section 1231 net gain as a capital gain, it must consider an exception to the basic characterization rule. Okay, so if you sell a Section 1231 assets and you have a capital gain, before you characterize it as normal, you have to look at whether we have um, any Section 1231 net loss in the last 5 years or not. So this exception apply if a taxpayer has a Section 1231 net gain in the current year, but a Section 1231 net loss in any of the 5 preceding taxable years. In such case, um, the taxpayer must recapture the prior year loss, which was deductible as ordinary loss, by characterizing an equivalent amount of current year gain as ordinary income. Okay, so it means like this. If you sell a Section 1231 assets this year, okay, this current year, and you get a Section 1231 gain, before you can treat it as capital gain, you need to look at the 5 years, the 5 preceding taxable year, whether you have a Section 1231 loss or not. Now, if you have a Section 1231 loss, then you need to treat the amount that you gain in the current year, a part of that as ordinary income, up to the amount of Section 1231 loss in the past. Okay, for example, Company A has a 24,000 Section 1231 gain in 2018. Now, this table shows what happened in the last 5 years. So if you look at the last 5 years, we have net Section 1231 loss, 6,200 in 2015, and in 2016 we have 900 Section 1231 loss, the net amount. Okay. Now, so the total Section 1231 loss that we have in the last 5 years would be 7,100. Okay. So if we sell the assets and we have 24,000 gain, okay, we have a 24,000 gain in 2018. Okay, of that 24,000, we have to recognize 7,100 as ordinary loss. It will be equal to the amount of the net Section 1221 loss in the last 5 years. And the rest of the amount, we take 24,000 minus 7,100, that will give you 16,900. So you will recognize at Section 1231 gain. Okay. Now, why the government want us to do like this? Because when you have a Section 1231 loss, you see in the past, you can deduct it as ordinary loss. Okay, so it's very good for you because you already deduct it as ordinary loss. Now, if in 2018, when you sell the assets and you have a Section 1231 gain, 24,000, and if you recognize all of this gain as capital gain, it would be too good for you because in the past you already can deduct some of the Section 1231 loss. So the government say no, if you already deduct some of the Section 1231 loss, now that amount, the same amount, you have to recognize as ordinary income in the current year. Now, this will help the government that, if they don't do like that, And if you can get recognize all the 24,000 as section 1231 gain, it means you can treat it as capital gain, and so you can use it to deduct all the capital loss. So the government doesn't want that. Okay, so they want you to treat a part of that as ordinary income up to the amount of section 1231 loss that you can deduct in the past. Okay, now let's continue. So let's look at the disposition by abandonment. Okay, so it say the taxpayer may abandon worthless property by disclaiming any ownership interest in the property. So we learned that there are three ways that we can dispose the property: by selling it, exchange, or abandon it. Abandon is mean we throw it away. We don't need it anymore. So uh, we need to recognize any loss, okay? And the loss that we recognize will be equal to the adjusted basic of the abandoned property, and the loss will be characterized as ordinary, regardless of any type of the assets, because there's no sales or exchange. For example, if I have an equipment and it has an adjusted basic of 5,000, okay, if I have an equipment and it has an adjusted basic of 5,000, now I decided to throw that equipment away because it cannot be used anymore. So in this case, because it still have an adjusted basic of 5,000, so since I decided to throw it away, there will be a loss recognized of 5,000, which is equal to my adjusted basic. And this loss is characterized as ordinary loss. Okay. Okay, and for worthless securities, we we also apply abandoned rules, but it will be a little bit different. So for worthless security like a stock, worthless stock, okay? And if you decide to abandon the worthless security, the amount realized will be zero, and the loss that you recognize will be equal to the adjusted basic of the security, but it would be characterized as capital loss instead of ordinary loss because the security is a capital asset. Even though you throw it away, it's still capital asset. So when you abandon it, then it should be a capital loss. Okay. For example, you have $3,000 investment in your security, in your stock of some company, and now you don't want it anymore. So you abandon this worthless security, and it will be equal to the adjusted basic of the security, and it will be the capital loss. Okay, when you abandon this worthless security. Okay, so there was some exception for the security in an affiliated corporation. Okay, it say corporate parents recognize loss on worthless securities issued by a domestic subsidiary is ordinary if the subsidiary is an affiliated corporation. Affiliated corporation here is mean it has 80% or more of outstanding stock is owned by the corporate parent, and the subsidiary derives more than 90% of annual gross receipts from the conduct of an active business. Okay, so um, if the security is issued by a subsidiary and it is an affiliated corporation with the parent, then the loss when we abandon those worthless security, it would be recognized as ordinary loss instead of capital loss. Okay, so remember this is exception if they are affiliated corporation, subsidiary, and parent. And if we abandon those worthless security issues by the subsidiary, then this loss is recognized as ordinary loss. Okay, disposition by foreclosure. Okay, so this happened uh, when, for example, a company they borrow money when they purchase an asset. Okay, and in this case, let's look at, for example, it's a record debt. Record debt is mean the debtor is personally liable. Personally liable here means if they cannot pay back the debt, they have to pay from their pocket money. They have to sell their own property to pay back for the debt. Okay, and so the foreclosure is treated as a sale of the property for fair market value. Foreclosure is mean if the company default on the assets, is they don't pay back the debt. So another company can take the property and it will be treated as the sale of property for fair market value. And if the creditor forgive any amount of the record debt, the debtor recognize the ordinary cancellation of debt income as ordinary gain. Okay. Let's look at example. Okay. Example. For example, a business or investment land with a 340,000 fair market value and 400,000 basic and subject to 375,000 market recourse market. The firm default on the market and the market holder foreclose the land. Okay, so what does it mean here? For example, a business has investment land with a 340,000 fair market value, okay, and 400,000 basic. Okay, so last time when they purchased the land, they paid 400,000, and this is this is um a recourse debt. Recourse market is mean the company is personally liable to pay back for this market. Okay, so if the company default on the market, they don't pay back. They cannot pay back. So the market holder is mean the person who lend the money um will foreclose on the land. It means they will take the land. Okay. So in this case, there will be 60,000 capital loss because we will use the fair market value at the same as the sale of the land and minus 400,000, and that will give you 60,000. Because this is an investment land, so it would be a capital loss because this investment land is a capital asset. Now, if this land is used for business, then this loss, 60,000 loss, will be section 1231 loss. If this land is, you know, used as inventory. For example, this business is a real estate business. So in this case, if this land is as an inventory when they are a real estate business, then this 60,000 will be ordinary loss. Okay. And so because the debt is 375,000, the company will need to pay 35,000 more for the market holder But if the mortgage holder forgive the 35,000, it means tell them that they don't have to pay back the 35,000 remaining debt, then the business recognize the 35,000 as ordinary income. Okay, but they actually because it's a record debt is mean you are personally liable to pay back the debt. Okay, the debtor is personally liable to pay back the debt, so they have to be responsible to pay back the debt from their own pocket money, from their personal assets. But if the creditor forgive this remaining amount, then you have to recognize as ordinary income. Now, what happens if this is a non-cost record debt? Non-record debt is mean the debtor is not personally liable. They don't have to use their pocket money. They don't have to sell their own assets to pay back the debt. Then, in this case, the foreclosure is treated as the sale of the full amount of the debt. Okay, for example, here, the same example, but now it's a non-record mortgage. So now, because we owe them 375,000, right? So 375,000 now it will relieve the debt and minus 400,000 basic. We lost about 25,000, and this is a capital loss because the investment land is a capital asset. Okay, we lost 25,000. Okay, the last one, disposition or by casualty or theft. So what happens if our business assets is lost by the thief or is lost by natural disaster? So in this case, if we buy the insurance for our assets, we will receive the insurance process from the company. Okay. Now, if the amount of insurance we receive is less than the assets basic, then there will be a loss, and we have to recognize that loss as ordinary. But if the process are more than the assets basic, then we will recognize gain. Okay, and we will learn more about chapter 9. That some condition, some situation that we can delay recognize the gain. Okay, so that is all for chapter 8.